On opening day, a new hotel feels complete. The lobby is full, the restaurants are serving, and revenue is finally flowing in. But when the physical action freezes, the underlying financial machinery is still running, unresolved. The doors may be open to the public, but the financial project phase remains legally active. Millions of dollars spent during the pre-opening process have not yet been officially reconciled. To bridge this gap, the property must execute the final audit of pre-opening expenses against the approved pre-opening budget, or POB. For the Director of Finance, completing this specific audit is a mandatory requirement to satisfy strict lending covenants and clear the ownership group's mandates. Treating the ribbon-cutting ceremony as the financial finish line creates a severe fiduciary liability. A legitimate transition into operational status requires certified, documented financial closure. This intensive review does not wait. It triggers immediately following the grand opening, reaching its exact execution window at T+30 days. The raw material for this audit comes directly from the general ledger, pulling every actual expenditure recorded during the entire pre-opening process. Those actual expenditures are then measured against a strict baseline, the exact line-by-line figures established in the approved pre-opening budget. This schematic illustrates the mechanism. The general ledger actuals stream in on the left, and a line-by-line review maps them against the fixed targets of the POB on the right. The process tests the integrity of every financial control and authorization limit established months earlier during the procurement phase. This forensic sorting engine scrutinizes every transaction to hunt down specific anomalies across the entire pre-opening timeline. As the transaction data passes through that filter, the Director of Finance sorts the discrepancies into 3 primary variance categories. This dashboard identifies the first category, over-budget variances. These are instances where actual expenses exceeded the approved line item, triggering a red alert accompanied by the required budget variance request document. When identified, the Director of Finance must secure documented signed approval for that specific excess spend. The approval chain must strictly follow the project's pre-established authorization matrix, ensuring the correct level of management signs off on the exact dollar amount. Without the required signature, an overrun is immediately escalated for direct review by the ownership group. Complex construction projects will inevitably experience cost overruns, but executing those overruns without proper documentation is a direct breach of financial governance. The second category identifies under-budget or savings variances. These represent funds that were allocated in the POB but not fully spent by opening day. There is a strong operational temptation to quietly absorb this surplus cash into the new operating budget to pad early profit margins. Unspent project capital must be identified, separated from standard operations, and physically returned to the owner or original project fund. The single exception occurs when ownership explicitly authorizes specific savings to be carried over into the operational stream. Project capital is strictly ring-fenced. Once day-to-day operations begin, the property must sustain itself on its own generated revenue, not on leftover construction cash. The third and most technically complex check in the final audit is identifying misclassified expenses. The finance team must meticulously distinguish between a standard pre-opening expense, like staff training, and a capital expenditure, or CapEx, such as the purchase of physical kitchen equipment. Balancing the budget provides false security if large capital purchases are buried within operating expense lines. Incorrect capitalization corrupts the fixed asset register. An equipment purchase misclassified as a general expense entirely removes a depreciable asset from company records. The precision of this register directly dictates the integrity of the opening balance sheet. A misclassified expense records a false initial valuation for the property, mathematically distorting tax liabilities and depreciation schedules for years into the future. Once the line-by-line review is complete, the finalized data is assembled into the ultimate project deliverable, the POB closeout report. The first mandatory section of this report provides the overarching financial summary, directly comparing the approved budget totals against the final actual expenditures. This view details the second requirement, a comprehensive explanation and justification for all material variances. Standard practice flags any line item deviating by more than 5% from the approved budget. The document must then formally certify that all temporary pre-opening bank accounts have been definitively cleared and closed. It also provides legal proof that all outstanding project liabilities and vendor invoices have been fully settled. This single report takes thousands of disparate project transactions and synthesizes them into a verified certificate of financial readiness. This visual represents the transition. The POB closeout report serves as the official financial handover document presented to the ownership group, replacing the scaffolding of the project phase with a solid operational foundation. When ownership accepts this report, it legally and formally terminates the Director of Finance's pre-opening project responsibilities. The hotel is now officially certified to cut ties with project funding and operate strictly under the standard annual operating budget. Executing this exhaustive process provides total transparency to the investors regarding how every dollar of their initial capital was deployed. This rigorous, uncompromising approach to project spending is the defining standard for financial governance emphasized at the Europe Hotel School, London. Flawlessly closing the project books is the final, defining act of financial leadership, ensuring the hotel's operational life begins with a verified, stable foundation.